Today, we are going to understand the RBI's ECBA framework for urban cooperative banks. An RBI framework came into public consultation in July 2025 with feedback invited until August 2025. Let me introduce myself. My name is Ms. Swati. I am the AI associate of Dr. V.V.L.N.Sastry. I am presenting his narrative on its development to you all. Hello, everyone. Welcome back to Dr. V.V.L.N.Sastry's YouTube channel. Today, we're diving into an important update from the Reserve Bank of India, or RBI, that could affect millions of people using services provided by urban cooperative banks, also known as ESBAs. So, whether you're a customer, a bank employee, or someone just curious about the financial system, this video will break down the new rules in simple terms. Let's get started. As you may know, the Reserve Bank of India plays a key role in maintaining the health and stability of our banking system. Recently, the RBI introduced a new framework called the Eligibility Criteria for Business Authorization, or ESBA, for urban cooperative banks. But what does this mean? Why should we care? Let's break it down. Until now, the RBI used a set of rules called the Financially Sound and Well-Managed FSWM norms to regulate ESBAs. But now, the RBI has updated its approach with the ESBA framework. The goal here is to make ESBAs even more reliable, trustworthy, and efficient for all of us who depend on them for things like savings, loans, and other financial services. What does ECBA means? ESBA stands for Eligibility Criteria for Business Authorization, and it's a regulatory framework introduced by the Reserve Bank of India to streamline and improve the governance, financial health, and operational standards of urban cooperative banks. Essentially, it's a set of guidelines that ESBAs must meet to ensure that they can safely and responsibly expand their business activities, like opening new branches or ATMs. Before ESBA, ECBAs had to comply with something called the FSWM, or Financially Sound and Well-Managed norms. While these norms worked to ensure that banks were financially sound, the RBI found the need for more clarity and a more detailed set of requirements that would also account for operational growth and technological advancements. So, the ESBA framework replaces FSWM, giving clearer guidelines for ESBAs looking to expand. So, what does the ESBA actually do? Well, for starters, it sets clear rules about how ESBAs can expand their businesses. If a ECB wants to open new branches, ATMs, or even processing centers, they need to meet certain criteria. The bank's financial health has to be strong enough to handle such growth. This includes meeting requirements related to their annual audited financials, which is the bank's official financial statement. Under the ESBA, banks must also maintain something called a capital adequacy ratio, or CAR, which ensures that they have enough capital to absorb any losses. Additionally, ESBAs need to make sure that their net non-performing assets, or NPAs basically, bad loans that are not being repaid, don't exceed 3%. This is important because it protects the bank and its depositors from financial risk. Next up, let's talk about profits. The ESBA framework requires that ESBAs report net profits for the last 2 years. This means that a bank cannot expand if it has been making losses or if its balance sheet shows accumulated losses. They also need to comply with important banking norms like the cash reserve ratio, CRR, and statutory liquidity ratio, SLR, ensuring that they maintain proper reserves to safeguard their operations. Now, let's discuss technology. Under ECBA, ESBAs must implement core banking solutions, or CBS. CBS is a system that allows all of a bank's branches to operate seamlessly and in real time. This technology helps make banking more efficient and ensures that customers can access services no matter which branch they visit. On the governance side, the framework mandates that ECBAs have at least 2 professional directors on their boards. This is to improve decision-making and make sure that the bank is run by people with the right expertise. It also ensures that banks are not under any RBI supervisory actions, meaning they have to be in good standing to operate smoothly. Every year, banks must assess their compliance with the ESBA framework by reviewing their financial statements. The bank's board of directors must approve the compliance and notify the RBI within 15 days. This keeps things transparent and ensures accountability. So, What about expansion? Here's the interesting part. Large ECBAs, which have a net worth of at least 50 Indian rupees crore, can expand their operations beyond their home state. They can operate in 2 additional states per financial year, but they need to meet the capital requirements to handle at least 5 branches per state. Within their home state, they can also open branches in up to 3 districts without seeking RBI approval. Now, the RBI classifies ECBAs into 4 tiers based on the size of their deposits. For example, Tier 3 banks have deposits between 1,000 Indian rupees crore and 10,000 Indian rupees crore, while Tier 4 banks hold deposits of more than 10,000 Indian rupees crore. Each tier has its own set of regulations and expectations under the ESBA framework. To wrap it up, the ESBA framework is a significant step forward in making urban cooperative banks more transparent, efficient, and stable. It gives these banks clear guidelines for growth, helps protect depositors, and ensures that they meet high standards of governance and financial health. If you found this video helpful, don't forget to like, share, and subscribe for more updates on financial regulations and other important news. If you have any questions or thoughts on the ESBA framework, feel free to leave them in the comments below. I'll see you in the next video. Don't forget to subscribe to Dr. V.V.L.N.Sastry's channel. Thank you for watching.